This video, I want to talk about understanding the challenges of impact investing. Actually, impact investing, while offering numerous benefits, also presents several challenges. And so, here is a detailed look at some of the key challenges of impact investing. Number one is measuring impact. Measuring impact. And so it has to do with quantifying outcomes, accurately measuring and quantifying the social or environmental impact of investments can be complex, and it's really subjective. It's difficult to measure and it's complicated, in nature. You equally have a lack of standard metrics. Lack of standard metrics. There is no universally accepted framework for impact measurements, leading to inconsistency and difficulties in comparing impacts across different environments. So it's difficult to really measure, impacts, because there's no universally accepted framework for quantifying, these impacts when it comes to investing. Number two is limited data and transparency. Limited data and transparency. So when it comes to data availability, reliable and comprehensive data on the impact of investment can be scarce, making it challenging to assess performance. There's no sufficient data to be able to assess the impact of this strategy. You equally have transparency issues. Some impact investments may lack transparency in reporting their impacts, and making it difficult for investors to verify their claim. There's this issue of greenwashing risk. They provide information that is not genuine, and that's even difficult to verify. You see, and that leads us to number three: greenwashing risk. Greenwashing risk. It has to do with misleading claims. Some companies may exaggerate or falsely claim their impacts, a practice known as greenwashing. This can mislead investors into believing they are supporting more sustainable or socially responsible initiatives than they actually are. That's, dishonesty. That's almost like scam or fraud or misrepresentation. Is an important challenge when it comes to impact investing. It equally involves, detection difficulties. Detection difficulties. So identifying and avoiding greenwashing can be challenging without thorough due diligence. It's difficult to detect. It's difficult to actually uncover the true nature of things, the true states of things when it comes to impact investing as a result of this practice of greenwashing. Number four is trade-off and financial returns. Trade-offs and financial returns, and it inculcates the potential lower returns. Some impact investments may offer lower financial returns compared to traditional investments, particularly if they prioritize impacts over profit. When you put impact first and profit second, then of course you should be ready to forego a considerable level of positive returns. You also have return uncertainty. Return uncertainty. The trade-off between impacts and financial returns can create uncertainty and require careful consideration by investors. There is no certainty of return because you are targeting impact, instead of the return itself. So it generates uncertainty when it comes to the level of returns you are going to obtain at the end of the day. Number 5 is limited investment opportunities. Limited investment opportunities. When it comes to this particular factor, market size is also worth considering. The range of available impact investment opportunities can be limited, particularly in certain sectors or regions, potentially constraining investment choices. When it comes to impact investing, qualifying companies or sectors are kind of limited, and this will act as a constraint or a restriction on the level of profit or returns you are likely to make. Not only that, you have emerging markets. So investing in impact opportunities in emerging markets can involve a higher risk and, of course, uncertainty. When it comes to emerging market, the standard of reporting is not as transparent as what was obtainable in the developed markets. So emerging market has that particular issue of subpar level of transparency when it comes to disclosure. You see. And number 6 is complexity in managing impact. Complexity in managing impact. And that has to do with strategic alignment, ensuring that impact goals aligns with investment strategies, and managing these goals over time can be complex. You want to, consider, your returns, and you equally want to consider impacts. So it makes the entire process a little bit complicated. You equally have ongoing monitoring. It involves ongoing monitoring. So continuous monitoring and management of both financial performance and impact requires additional resources and expertise. It's resource tasking. You will need experts to be able to come in and be able to monitor to ascertain the level of impact these companies are producing in their respective areas or fields. You equally have number 7, liquidity concerns, and this will inculcate, investment horizon. So many impact investment, especially those in private equity or real assets, may have, higher investment horizons and limited liquidity, making it difficult for investors to exit their positions. So that liquidity that you expect may be lacking. You may find it very difficult to exit your investments, when the need to do so arises. You equally have a market access. So access to liquid impacts, access to liquidity or to liquidity impacts investment. It can be somehow, problematic, because as a smaller investor, you need to have that liquidity to go in and go out as at your will, but this may not be quite available when it comes to ESG or impact investing. So that market accessibility is somewhat limited because of lack of liquidity. So number 8 is regulatory and political risk. Regulatory as well as political risk. And there's changing regulation, as we all know, and not only that, impact investing is subject to regulatory changes, which can vary by country and may affect the attractiveness and viability of certain investments. Equally consider political influence. See, shift in political priorities and policies can impact the attractiveness, the effectiveness, and the sustainability of impact investment. So the political environment equally play a part. The regulatory environment equally, contributes to the challenges that faces this particular strategy. Please subscribe to this channel and like this video. Don't forget to share and to ring the notification Bell. Number 9 is subjectivity and bias. Subjectivity and bias. So this will also inculcate, impact criteria. So different, investors may have varying definition of what constitutes meaningful impact. It tends to vary from individual to individual, leading to, a subjective and potentially inconsistent evaluation. Not only that, you have biases. So investors' personal and institutional biases, can influence their impact priorities and investment choices. So the biases are there, and the criteria may tend to differ from individual to individual. It's really, really challenging. Number 10 is integration with traditional financial metrics. Integration with traditional financial metrics, and this would involve complex analysis. So integrating impact factors with traditional financial metrics can be complex, potentially complicating performance evaluation and decision making. Difficult to inculcate, uh, impacts, metrics into our traditional accounting system. That provision, I think, is not yet, built into the traditional accounting, practice. You equally have, performance attribution. So linking financial performance directly to impact goals can be challenging, making it difficult to assess the value generated by impact investments. So how do you link financial performance directly to impact goals? It's somewhat challenging. Somewhat challenging. You may have your goals met, but it may not be adequately, effectively, or sufficiently linked to, to your financial performance actually. Number 11 is capacity and expertise. Capacity and expertise. So in this particular concept, there's that skill requirement, skill requirements. Effectively managing impact investment requires specialized knowledge and expertise in both impact assessment and financial analysis. So resources, that resource constraint is equally a factor. Resource constraint. For individual investors or smaller institutions, the resources needed to conduct thorough due diligence and ongoing impact management may be limited. So that constraint in resources is a major challenge in analyzing the impacts, of this level of investing on financial performance.